In Peter Drucker's 1976 classic, The Unseen Revolution, he properly forecast that the funds that would be supporting pension plans would ultimately grow to an enormous size in the 21st century and become significant players in capital markets. Well, his predictions have come true because 45 years later, in 2020, pension plans held approximately $46 trillion US in total assets around the world, and they're growing rapidly. They currently represent about 10, maybe as much as 15% of all global wealth. And it's worth noting that the amount of money under pension fund management has doubled in the past decade. And in the same book, Drucker conveniently identifies for us 5 best practices for pension fund management that are still a useful guide for managing today's plans. And so I want to take a bit of time to explore each of these and consider them in context of modern pension fund management. The first of these is what he calls mission clarity and organizational autonomy, things he sees as being essential to remove the principal agent problem from pension fund management and to undermine government's tendency towards overpromising. Secondly, he suggests that pension funds adopt what he calls sensible investment beliefs, not making pie-in-the-sky estimates about what sorts of returns the fund will earn. Again, hope in prayer is not exactly a plan when failure of it will ultimately lead to elders not getting enough to eat. Thirdly, he makes a point about emphasizing good plan governance, which means that the people running the plan need to have a sense of public duty as opposed to simply trying to extract the maximum possible benefit for themselves. Fourth, he suggests that plans ought to be right-scaled, implying that the designs of pension plans are dependent on the scale of the operation, and that what is appropriate for a pension plan that covers 10 or 20 million people might not be appropriate for a pension plan that covers 10 or 20,000 people, let alone 1,000 or 2,000 people. Finally, he points out that pension plans need to be what he calls right peopled. In other words, that you ultimately require the proper kinds of oversight and the proper kinds of investment management skills in order to properly steer these sorts of large pools. So we'll take a few minutes to consider each of these in a bit more detail, because at the end of the day, if we're hoping to redesign the pension plans that we have now to make them more sustainable, perhaps even more beneficial in the future, then we'll need to think through some of these key design issues related to pension plans. So in the first one for us to consider is autonomy. In general, it's been identified that pension plans function much better when they can avoid interference with their sponsors. And a big part of this has to do with sponsors' willingness to offer benefits that can't possibly be met by the underlying plan or portfolio as it's financed. For instance, when we take a look at the recent financial problems that were experienced in Greece over the last decade, a significant contributor to government, the problems with government finances were that the state-backed pension plan gave full pensions to women starting at age 50 and full pensions to men starting at age 57. A full 15 to 8 years before the Canada Pension Plan itself would kick in. Now, under pressure from their European partners who ultimately bailed out the Greek government in 2016, this pension plan's age was increased to 67, with an option to retire earlier at 62, effectively plugging this massive hole in the government's budget by paying out enormous benefits to people that hadn't been covered by their contributions. Now, without having any sort of proper mission autonomy, and one of the things that can happen is that sponsors may decide that a particular plan is sufficiently funded for now. And this was the case with a number of pension plans in the early 1980s. Because the estimations of portfolio returns are generally based on the historical record, many pension plans found it very convenient to estimate that the kinds of high interest rates we saw in the early 1980s would persist throughout the 80s and 90s. They also felt that the high stock market returns, which were being experienced in the early 80s, would also continue. And this led to a very serious problem in that people formulated their beliefs off of just a small subset of recent economic history, as opposed to looking back over the full length of data that was otherwise available. So, of course, this led in the mid-1980s to sponsors deciding that their pension plans were sufficiently funded as long as they could expect the same kinds of 8 or 9% rates of return that they'd earned earlier in that decade. And that meant that some of them chose to take what were called pension holidays, choosing not to make their own contributions and giving their employees a sense that your pension is very secure, but you don't have to contribute to it because we've been so successful with the investments. The problem is that they hadn't been so successful with investments. They merely forecast that they would continue to be as successful with investments as things had been. And we all know that beating the market doesn't mean much when the market is down. And so while pension plans require these kinds of absolute returns in order to meet their absolute obligations, what we found ultimately is that these sponsors underfunded their plans. For example, U of T's faculty pension plan made this assumption in the late 1980s and proceeded to take 8 years of pension contribution holidays in a row, in which the sponsor redirected its contributions to other parts of the budget, and in which the employees at the time felt that they had earned their way to a decade-long pension holiday. Well, unfortunately, when you fast forward 30 years, U of T is now finding itself in a position of asking its current employees to increase their pension contributions in order to be able to continue meeting the benefits for retirees who enjoyed a decade-long pension holiday. So it's important to some extent that we separate the control of pension plans, at least in Drucker's opinion, from their sponsors, because it can lead to this kind of malfeasant behavior that ultimately which are borne by the beneficiaries, not the sponsor themselves. Another important thing is to set an appropriate benchmark for expected returns. Now, usually, pension funds have a different kind of objective than a regular mutual fund or other kind of investment portfolio might have. While these other portfolios might strive towards the maximum Sharpe ratio or a best risk-adjusted return, pension funds often find that this is an inappropriate technique for them. Because even if you were to maximize your risk-adjusted returns, it does not necessarily mean that you're going to have sufficient cash flows at the appropriate time to meet your actuarial obligations. So most pension funds work backwards, figure out what rate of return is required to meet their obligations, and then consider how to structure their portfolios to meet those obligations. So rather than focusing on trying to earn the highest risk-adjusted return like a traditional mutual fund or a hedge fund might try to do, pension funds instead should focus on meeting their actuarial requirements. Now, of course, that doesn't mean that a pension fund should stop trying to earn good returns when it meets its target. Instead, the best technique is for pension funds to establish a particular degree of risk tolerance that they're willing to accept, and then motivate their managers to seek out the highest rates of return that they possibly can without violating that risk level. Now, it's important to recognize that pension funds can often achieve their objectives simply by indexing, buying a broad index of stocks or bonds as in such a way to keep down their costs and still achieve a broad sense of diversification. However, it's important to note that if we're going to actively manage a pension fund, that the target return must be better than the index in order to cover management costs. Otherwise, it's possible to earn a return that is less than what an indexing strategy would have provided once we factor in expensive management. Now, in consideration of setting an appropriate target, I'd like to discuss the particular example of the Ontario Teachers Pension Plan, originally the Ontario Teachers Superannuation Fund. The Teachers Superannuation Fund originally was mandated to only invest in Ontario of government bonds, a practice which was very beneficial for the government, channeling billions of dollars into their coffers, which allowed them to keep their borrowing costs down. But it also led to subpar returns that almost led to the collapse of the plan in the 1980s. The teachers ultimately sued the Ontario government to acquire control of what assets remained. The government was more than happy to hand over the $20 billion that was left in the superannuation fund to them in exchange for discharging their obligation to meet their pension requirements. So once the teachers had seized control of their own pension assets, it's interesting to note that they radically changed the style of portfolio allocation to meet a different target. Rather than focusing on a target of a minimum amount of risk, they instead chose to focus on a target that would provide some growth or some returns. And it's worth noting that the pension plan now has roughly 10 times the assets that it did when it was originally handed over to the teachers in the 1980s, and has averaged a return after expenses of 9.7% since 1990, beating the broad stock market's performance, even though the teachers' pension plan is invested in a diverse portfolio, which includes fixed income, corporate bonds, sports teams, infrastructure, insurance, investments in hedge funds, and many international opportunities. So the Teachers Pension Fund has done particularly well and is in fact one of Canada's flagship pension plans, is well regarded internationally, and actually formed the basis for how we reformed the Canada Pension Plan a decade later. Now, when we're thinking about the broad portfolios of a pension plan, following on Drucker's suggestion that they need to have a right target, it's important for us to think about how the constraints of a pension plan come into play. In general, pension plans involve portfolios that are long-lived because many of their obligations won't come due for a long period of time. And this means that it's reasonable for them to invest in long-dated illiquid securities that are expected to generate long-term yield. The goal of a pension plan is effectively permanent ownership, not actively trading and trying to capture swings in the market. The goal of the pension plan ultimately becomes somewhat of a value investing approach, where we try to buy performing assets at relatively low and inexpensive prices so that we can capture a regular yield on the invested capital, as opposed to hoping to trade in and out of a particular security. Now, of course, one of the things to watch out for when making pension fund allocations is that sponsors should not be channeling these retirement assets into their own shares. This is exactly what happened at Enron when it collapsed roughly 20 years ago. Employees had been incentivized to invest their 401ks or their individual pension plans into Enron funds, and the company's pension plan itself was heavily invested in Enron itself, meaning that when the company collapsed, of course, all of its pensioners were an unsecured liability of the firm, but the underlying assets of the pension plan collapsed along with it. So it's important to think carefully about how a pension plan actually allocates its portfolio. Even though some of these pools might be large enough to own these sorts of large non-divisible assets that provide a high rate of return because there are fewer competitors who can afford to buy them, it's still important to remember that diversification of risk is an essential building block of any portfolio, whether it's long dated or short dated.